Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what people are sharing. If you want to follow me at Score Finance, and if you want to join our community, finding-value.com, what I do is I do question and answer sessions on the weekend. They are recorded and I put them on the website. I also do midweek updates of all the companies that I follow. And I make comments of what I would do in those things. So you've got a midweek update that's released Tuesday night, Wednesday morning, or I should say, and you could attend a Zoom meeting on the weekends, either Saturday at 7 a.m. or Sunday at 5 p.m. If you're interested. We have a special going on. Special is the coupon code if you'd like to join. So Eric Nuttall says, over the past decade, total non-OPEC oil production grew by 5 million barrels per day. U.S. shale, a component of that, grew by 6 million barrels per day. Without shale, the world would have experienced a supply crisis. That is why the twilight of the U.S. shale is so important. It equals radically lower growth rates ahead. So let me read that one more time so you guys can understand it. The total non-OPEC oil production grew by 5 million barrels per day over the past decade. And then U.S. was a component of that grew by 6 million. So kind of tough. How can you grow by 6 million barrels per day? And non-OPEC oil production grew by 5 million barrels per day. Sam Gatling says, is anybody else thinking about shorting crude oil when this pattern resolves? So this is the crude oil futures inverted. We had the bottom in 2020 and it ran all the way up. And then since this is inverted, he's saying, well, we're going to see a potential breakdown. If we get a move lower and we are underneath the cost curves, it's going to set up a super spike because people are going to get short like this guy, and then they're going to get squeezed out of it. And a lot of the times, that is what creates the false breakdown. You get a move lower for a temporary period, and then it squeezes all these people who don't know what the fair value is for crude oil, or what the cost break-even points are. But it could go down for a short period of time, and I would definitely not be shorting it at this level. If I were to short oil, I would have done it somewhere like up here and then rode it down and then got out of it. I wouldn't do it when it's below the cost curve. Yes, there could be a fear event in the market that could drive it lower. But if you're underneath the cost curve, you're kind of you already took away a lot of the runway, the easy money. Now this is all hard money, in my opinion. Against all odds research, the oil caught right now, the red line, the smart money is moving up. That means they're buying. The green line, the speculators, is moving down. That means they're selling. And they're doing this as open interest declines, which is the black line. That matters. So the smart money's buying, the speculator money is selling, and then we've got the black line, which is open interest is declining. Check out the insider buying at Whitecap Resources today. No, really, check it out. I think they bought something like 1.4 million bucks. Whitecap Resources is an oil company. The reason I'm sharing this, and it's not necessarily the company that I'm sharing, it's the fact that a bunch of insiders are piling into their stocks at these prices. A lot of Canadian oil companies across the board, the insiders are just buying up shares nonstop. Are they smart money or are they not smart money? I would consider them ultra smart money. They know the industry quite well, and they're all buying like heck. So are they wrong? Are they right? I don't know. But if I were to make a bet, I would bet alongside them. That's what I would do. Rich people get paid by the project and pay by the hour. So they pay their workers by the hour, and the people who make all the money get paid by the project. So that is completely true. And what I found just through life is there's only a couple of spots that you can really make a lot of money in the market. Owning your own business, salespeople can make a lot of money because sometimes they get a percentage of what they sell, and they can sell. Some industries they sell hundreds of millions of dollars, and if you get 5% of that, then you're doing quite well. But if you're getting paid by the hour, that's pretty rough. It's a rough lifestyle. Tavi says, it amazes me that silver's hovering near $35 an ounce, yet it remains incredibly cheap compared to gold. After the recent crash course on gold as the ultimate safe haven, I believe investors are about to have a history lesson about the role of silver as a monetary asset. Exciting times ahead in my view, and he thinks this ratio is going to decline, where silver is going to get more expensive in relationship to gold. I think that will be the case too. I think silver could run pretty big here. Maybe we hit 50, 60 bucks or 75 bucks or something like that over the next, maybe even this year. It's possible. That ratio would really drop to some degree. Silver breaking out. So we've got Steve, silver chartist. He's noticing. A lot of us are noticing silver. Silver's breaking out of its short-term triangle pattern, making a test of 34.24, followed by the October 35.07 peak. The path of least resistance is up. In a bull market, dips are for buying. And that is what I plan to do on the inevitable gut-wrenching corrections along the way. So he's buying the dips and holding on. That's what Steve's doing. In all honesty, guys, I haven't really bought much physical silver recently. I bought a whole bunch. I'd say 20. I'd say under 25. So I bought a bunch under 23. My big buying occurred in 2018. I bought a decent amount in 2020 when it was really low. And then I tapered it back. I bought some off a guy up north, bought whatever he had left. He sold it at spot, so I bought it in the low 20s there. I haven't really bought much after that. I've been a big platinum guy. Been buying platinum pretty much nonstop after that. GDXJ is breaking out again. Been saying gold 3,000, 3,300, and silver 40, $45 is next. After that, gold 5,000 and silver $100 is coming. Many have missed the big move the latest 14 months so far, as usual, and especially the up move since December lows. Most have, unfortunately, as usual, been listening to attention-seeking narratives about impending stock market crash, constant talk about metals manipulation and the USD going to the moon, instead of looking at price and understanding what is actually happening. And always remember that most have to be wrong at the wrong end of the sentiment at major turns and levels, always, including all analysts, experts, and services. Plus, one cannot play a resumed bull very well with a bearish mindset, or lack of the right tools or experience, or lack of the right guidance. That's why most miss the lows. Many call the top way too soon. Many called for ridiculous low numbers, plus bailed to get in lower. Only looking at the last, say, 10 weeks, it has become clear to many that it is vital to follow the right people. This is what I've been saying all along. It is vital for this bull market that you get the best guidance there is for many reasons. And GDXJ is starting to break out. There we go. Rippy. Looks good. And it's incredibly cheap against gold itself. Incredibly cheap. First gold, now gold stocks. The flight from stocks to gold miners has begun. There's the downtrend line for GDX divided by SPX. And it is starting to break out. I'm showing you guys this nonstop because this is where you need to get your confidence from. Your confidence needs to be derived from chart patterns, from downtrend line breaks, from cheap undervaluation ratios. You want everything at your back that you can put behind you in terms of tailwinds. A tailwind is buying something when it's cheap. That's a tailwind. A tailwind is buying something when it is historically at a low valuation for the sector, a low valuation for the company itself. And you're starting to break downtrend lines. Those are all tailwinds. So what I do is I try to look for confluence. I want to see that some asset is outperforming other assets. That's a ratio. That's what this is. This is a ratio starting to outperform. And that is a part of money rotating differently. It's a part of a different market condition that exists. And if you can find the rare setup where you've got, let's say, a gigantic falling wedge of an oil company against oil squeezing into the tip of that falling wedge at a really low ratio, and you've got a great setup against the dollar, and you've got oil in relationship to gold and other assets at incredibly cheap prices, like everything starts to align, and that's when you take the entry. It doesn't mean that you'll have an immediate move, but what it means is that all tailwinds possible are at your back. And that is where the highest probability of success with the most amount of asymmetry generally exists, and your risk-reward entry point is incredibly good. Rock bottom entry says silver is headed to all-time highs, and this is what we're seeing here. You're seeing a breakout recently, and we are running to the upside for silver. The Permian Basin and the physics of geology. Long story short, some unexpected breakthrough technological advancement is needed to prevent a decline in total U.S. shale oil production. We need a technological advancement. Now, maybe that comes. Maybe it doesn't. I don't know. But it looks to me that shale is peaking out in the short term here. And then they talk about the decline rates, 40% decline rates, requiring 1.5 million barrels per day of new production just to offset the losses of declines. Legacy well decay. Wells greater than 5 years old contribute just 12% of the initial output, but account for 63% of decline volume. Tier 1 exhaustion. 60% of Permian Tier 1 locations, break-evens less than $45 a barrel, have been drilled, forcing operators into Tier 2 zones requiring $60 to $70 a barrel break-evens. It says this creates a treadmill effect. Each 1% increase in decline rates necessitates 37,500 barrels per day of additional new production to maintain a flat output. And then Tier 2 locations for break-even, average is $65 a barrel. For remaining Tier 1, requiring sustaining $75+ WTI prices to justify development. We basically need $80, $90 a barrel oil to get any growth out of anything. Otherwise, if you get close to 75, they start pulling back, and then they say, we'll just hold on because the price is too close to our break-even. Christine says gas output is going to grow dramatically while oil is not going to grow meaningfully in the short term. The U.S. Energy Secretary said in a recent television interview, I'm heavily invested in the oil. I'm playing this heavy oil game. Oops, coming back. Kevin Bambro says, the guy said, let's do this. Your silver punt seems to be winners thus far. We'll just have to see if it will follow copper or gold on recession and uncertainty fears. He says it's not a punt. It's a deeply researched, high-conviction bet, just like the first time I bet on silver back in 99, 2000. Kevin knows the cycle, and that's exactly where we're located. I'm very content to wait as long as it takes and ride through drawdowns along the way to get the huge return I know is coming versus fiat. It's both offensive and defensive strategy. If you understand that both gold and silver are bought for both greed and fear in a bull market. It's the fear of loss that leads bonds and general equity holders to flee to silver as its safe haven asset. The greed brings the crowd and helps drive it to crazy bubble prices. It's fear, though, and the insurance owning silver provides that starts the ball rolling. When you look around and have trouble finding anything with great intrinsic value on a risk to reward basis, silver shines, though, or shines through. Safety with massive optionality is Kevin's opinion. I would agree. I would agree. Now, when I look at these investments, guys, there's a different mindset that I adopt versus other people's mindsets. Almost everyone that I come across, and I don't know why this is, their mindset is this. If it doesn't go up immediately, you are wrong. That's their mindset. So apparently, and if you go down in an investment, if you have a temporary loss for a period of time, they consider it a loss and it's completely unacceptable, and they sell it, they take the loss, and they move on. I do not invest like that. What I do is I separate price and I separate value. I look at the value, I look at the price, and if the price is dramatically below the value of the asset, what I deem to be a fair value for the asset, I buy that asset. It can fluctuate up and down in the short term, but in the long term, I think it's going to go higher because of the market conditions that are present. The market conditions is like buying silver back in 99, 2000. No one is perfect at their entries. So you could go down in the beginning of some of these investments, but in the end, you make dramatically more money adopting the longer time frame strategy because you're seeing the disconnect between the value and the price. The value is driven by historical precedents. So it's like you've got a bell. If you guys know what a bell curve is, it's a normal distribution. If all you do on a normal distribution is continually buy it when it gets to a 10th percentile and below, let's say that it's very undervalued, and you only buy during undervalued periods, you just have to wait for the return to the mean, or when it becomes expensive or overpriced, you can sell it if you want to. You don't have to, but you can, depending on what the company is and what they do. It's like betting on guys. When you see a guy in some, I don't know, you're at a mall, you're looking at all these people and you're waiting for the right time. The time comes and you see a guy that is 4 feet 8 inches tall. And then what you say is the next person that comes through that door is going to be taller than the 4'8" guy, which is the 10th percentile and below of the normal distribution curve of height. So I'm basically what I'm doing is I'm waiting and looking for undervalued assets that are really cheap compared to history, taking those areas or sectors, putting money in those areas and sectors across maybe 6, 7 different ideas that are all cheap like that, and then making a bet saying, I am betting in a few years' time that when I buy this at the 10% below area of how cheap it's been in history, that it will be more expensive in the future than what it is today. It is literally that simple. And then people are going to be like, oh no, it's got momentum. They're going to bet that the next guy coming through the door is shorter than 4'8" inches. And I just shake my head. I'm like, that is so dumb. I wouldn't make that bet at all. I would never make that bet. Oh, but it broke out of the support trend line. Okay, then good for you if you got lucky and made a little bit of money on squeezing the last little bit out of it. Good luck to you, is what I say. I'll take the opposite bet. I'll bet that most guys are taller than 4'8". After seeing this one individual, even though it might have taken me hours or days to wait for that individual to come, but that's my bet. So that's what it's like investing in undervalued stuff. If you avoid overvaluation, it also prevents you from buying market tops. So you avoid price to sales, price to book, price to earnings. whatever valuation ratio metric that you want to use, it prevents you from buying stuff at market tops. So if you're only buying undervalued assets, you get to skip out on market tops. You get to buy undervaluation. Then you just have to be patient enough for a different market condition to come to get revalued. That's the whole deal there. Here's Jorge. We've got U.S. oil inventories down since the beginning of the year. There's the beginning of the year, and we've declined for total U.S. oil inventory. This doesn't happen in bear markets, guys. Sorry. Holger, my boy Holger. He says U.S. inflation comes in lower than forecast. Headline CPI slows to 2.8% in Feb from 3% in January, smallest since November of 2024. Core CPI cools to 3.1%, lowest since 2021. Housing inflation cools, airfares and pump prices drop, but inflation data doesn't yet reflect tariff impact. So that's what's going on with inflation, with our highly manipulated inflation numbers. U.S. implied oil demand, products supplied in million barrels per day, up, looking pretty strong for 2025 in the red. Bullish EIA weekly petroleum stocks data, total commercial stocks, excluding other oils, down 11 million barrels week over week. Implied WTI fair value price of $89 a barrel, $21 undervalued, more than 2 standard deviations below mean expectation. He is currently long physical crude by the way of CLK25 futures contracts. We are 2 standard deviations away. What happens if you were to do a bell curve here? Well, you're at the 10th percentile on the bell curve. And people are going to bet that it's going to go lower. Good luck. I mean, this would be the time where the data starts to support going long in oil and taking a contrarian bet. That's what I would do. Platinum alert. We got Bob talking about Platty. The following 50-year chart of platinum has shown an upward price trend since 1974. This is marked by the thinner gray lines. In addition, the last 3 years have seen a tighter consolidation pattern marked by the thicker gray lines. The shorter term and longer term lines appear to be overlapping with each other and appear to be nearing an apex where a significant move could develop. By 2026 is when the shorter term and longer term lines will converge. Here's the big uptrend. That's the thinner gray line. We've got the thicker one in the corner here. We're coming up to what will be a huge breakout to the upside. Why do I say that? Well, they cut back production in platinum. We are running deficits in platinum, and inflation is coming. That's why. Could we get a false breakdown? We could. And why would it be a false breakdown? Because they would stop producing platinum if it was low and went lower. That's why it dips like in 2020, and I bought as much as I could here. And if it dips again, I'll buy as much as I can. We're going to go up, and it's going to be a big move. Oil will move up with platinum. They're both inflation-sensitive assets. Commodities continue to shape up. We've got a breakout in copper. Go copper. There's a nice little resistance line that we're starting to break to the upside. Looking good. This is real. The best investors in the world are really good at doing nothing for long periods of time. That's it. There's the trick. The trick in the book. The best investors do nothing. Grady posts back here, posted, for example, this chart back in 2022, saying gold most probably had put in an 8-year cycle low. It did. And that a big move was coming because of that. And it did. Most back then did not believe it, which was to expect, as most are always wrong at big turns. I hope you took notice. This red parabola line fits perfectly, and the time frame makes complete sense for a move like this. If that moves like that, guys, we are going to see the dollar drop. That's what's pushing this higher. If the dollar drops, uranium, oil, silver, gold, copper, they're all going vertical. Gold is our leader. It's already forced running to the upside. It's going to run for many years. So we got a good Forrest Gump run going on, and everything else is going to follow behind it. So here we go. Here's Rick Rule. He says, my belief is that the next 10 years, the US dollar will lose 75% of its purchasing power. I'm not trying to say gold will go up 30-fold, but if that US dollar loses 75% of its purchasing power, it makes absolute sense that gold will go up fourfold. It's the dollar losing value, guys. It's coming, and it's going to impact everything. Everything. All those commodities. It could even bring the stock market in if we have that much purchasing power loss. QE Infinity says, strange, 10-year bond yields are soaring following today's cool CPI number. Shouldn't we be going the other way? Because people believe inflation is coming. Smart money is positioning for inflation. That's why the dollar's dropping too. They're chucking the dollars. Eric Nuttall says, sorry guys, this is not what an oil bear market looks like. These deficits, what the heck? It's all deficit land. Yeah. EIA inventory moves 312. Crude's up a little bit, but gasoline distillates are just getting smoked. Smoked. Huge product draws. Huge demand for how cheap the price is. It's too cheap. We need a more expensive fuel. But guess what? I'm sure there's no manipulation going on here at all. Look at that. We've never even seen this, I think, in history, ever. Freight futures AM update. Dry bulk. Capesize is up 7%. Panamax up 6%. That's huge. Tankers flat and Suezmax down 2%. Morgan Housel says, having more control over your time and options is becoming one of the most valuable currencies in the world. Totally agree. And then commodity prices from 1915 to 2024. Look at this. You got the big move in the early 1900s, consolidation, three-hump consolidation. Then you get another move, three-hump consolidation. Another move, three-hump consolidation. Another move, three-hump consolidation. Another move, three-hump consolidation. Another move. We're just going to keep going and going and going. That's what's going to come. So commodities looking good. Don't get frightened out at the wrong time. The time to get rich is by buying when share prices are low. So don't get frightened out, guys. That's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got a Saturday question and answer session coming up at 7 a.m. Mountain Time. Those are recorded. I upload those to the website. And that's all I've got for today. So we'll catch you next time. This is Finding Value.